Lex had never paid a lot of attention to his credit and the impact it could have on his financial life. He never truly understood the full impact until his first year out of college. Now, Lex was able to get an averagely paying job that was an hour 30 minutes from his home, which required him to look into purchasing a car for his commute. Given that he never paid too much attention to the over $40,000 he had in both student and credit card debts, he then obtained the car loan at an interest rate that felt like actual daylight robbery from the only dealership that was willing to accept his application. With poor financial literacy, Lex did some serious damage to his credit. When the debt burden became unsustainable, he decided to learn more about handling credit the right way. 2 years into his journey, he's down to his last $10,000 in debt and considers himself truly lucky. With the significance of a good credit history and credit score, I felt it might help to discuss practical ways to build this organically and ensure we do not fall into that pit of bad credit score. Hi, hello, salve. How's it going, everyone? My name is Chris and welcome to my channel. If you're new to the channel or you're a returning viewer to my channel, you're both equally welcome. Now, let's talk about credit. So, there are two sides on the island. There are those who think you should stay away from it because, credit card is evil and it will destroy you eventually. And there are those who believe credit is awesome and building good credit might be a great tool that would help you when working towards financial independence. But regardless of how you feel about credit, the simple truth is it's literally one of the most important aspects of personal finance. The benefits of a good credit history and credit score cannot be overstated, but allow me to list out a few. To begin with, it provides you lower interest rates on loans and lower APRs on credit cards, improved chances of having your loans even approved. It also ensures you get significant savings on interest rates on loans. For example, a 2% difference in interest rates over the years can practically save you tens of thousands of dollars over the lifetime of a loan. Let's take a mortgage, for example. Imagine a 20-year fixed mortgage of $400,000 at 4%. Ideally, this will cost you a total of $580,000 over 20 years. However, imagine this was obtained at 2% interest rate instead. With just 2% difference, you'd be paying $485,000 for the same mortgage over 20 years. That's a huge $95,000 difference over those years. Just literally gone. With the wind, gone. It also provides you better terms on different loan products, even better houses and real estate deals. A different way to think about it is that great credit scores can literally open doors for you. You can even get better car insurance rates and lower insurance premiums. You are generally in a better position when negotiating with financial institutions. Building great credit, like most good things, will require effort and focus. Without establishing that good credit record, it will be a huge challenge interacting with financial institutions, including banks, credit unions, lenders, insurance companies, and other companies. Some prospective employers also check candidates' credit history. Insurance companies use it as a factor to determine your rate. Even utility companies may check your credit before letting you open an account with them. Now, let's briefly discuss the basics of credit, how it works, credit scoring, and why this is very important. To begin with, what is credit? The word credit has several definitions, but for the purpose of our discussion, think of it as a borrower receiving money or something of value from a lender. This has to be paid back in full at a contractually agreed upon date in the future. Usually, when the borrower repays the money to the lender, the principal is paid back with interest. The principal here is the original amount that was borrowed. This credit can either be secured, where the borrower provides an asset as collateral, or unsecured, where the money is borrowed without collateral. Now, the word credit may also refer to the creditworthiness or credit history of an individual. As a borrower, your creditworthiness is simply a measure of how likely you are to repay what you borrowed. This creditworthiness can be determined by several factors, including your previous repayment history, annual income, amount of debt you already have, and things of that nature. Credit itself can be in various forms, ranging from mortgage needed to buy your home, a loan for that Dodge Viper you've had an eye on, a student loan for your college tuition, a line of credit for that family trip to Mount Everest or something, even a credit card to make use of for normal house items. You need to understand how credit works for you to be able to build a strong credit history. Credit is a tool that you must take full advantage of, but when used badly, it suddenly becomes your own master. Now, regarding creditworthiness, this is really a very sophisticated calculation, essentially summarizing your financial reputation and your ability to repay credit borrowed from a lender. It's like when a friend goes out to ask another friend, "Hey Susan, this John fellow needs some money from me. Do you trust him?" And Susan is like, the last time I gave him some money, he never paid me back, or it took him like 5 years to pay back. Essentially, it's an estimated figure that has been placed on the opinion formed over months or years about how you handled borrowed money. But over the years, creditors have essentially made this more objective, making it easier to make decisions. In the US and Canada, your credit history is a detailed lens into your creditworthiness. It shows your record of borrowing and repaying funds. There are 3 independent credit bureaus responsible for this: TransUnion, Equifax, and Experian. The last is not available in Canada. Usually, lenders, including banks, credit card issuers, and even credit unions, report your credit activities to these credit bureaus. With all these reports received, it goes through a very complicated algorithm and produces your credit score. They usually have varying credit scores for the same person. Credit scores are prepared by the credit bureaus, and it's a 3-digit number used by third parties, including financial institutions, credit card companies, banks, and other lenders to quickly and easily assess your creditworthiness and the risk of lending you money. People with a higher score are generally seen as lower risk, meaning that lenders will be more likely to offer them credit. The higher the score, the better your credit rating. Think of it as an aggregated summary of how good you have been at using and repaying money you've borrowed over the years, like a report card of sorts. It's also used to determine whether you qualify for a particular loan, mortgage, credit card, or other types of credit. A higher credit score shows that you have a recorded history of usually paying off loans, managing money properly, and that you are financially stable. On the other hand, a poor credit score shows that you might not be able to handle money well. Now, the credit scoring system we'll be discussing briefly applies to both the United States and Canada, and this is the FICO scoring system. In the US, your FICO score ranges from 300 to 850, while it ranges from 300 to 900 in Canada. The credit score range you fall within will be used in association with other criteria to determine the interest rate you pay on things like mortgage, automobile loan, student loan, credit cards offered to you, and how much you pay for insurance coverage. You should know that what is generally considered a good FICO score varies because each lender has their own standards for approving credit applications. However, you can easily track and monitor your credit score through paid subscriptions provided by the top 3 credit agencies, Equifax, TransUnion, and Experian. But if you're a rebel and you're not about that paid subscription life, there are free offerings from your bank or other companies such as Credit Karma, Borrowell, or even Mogul. At the end of the day, here's what you really need to know and remember. A high credit score can make it easier and cheaper to access financial products, whether it's loans, credit cards, or even mortgages. If you want to be in a position to get approved for those forms of credit, or better yet, receive the best possible rates available when you're looking at buying a house or a car, then you would have to be mindful of how you make use of existing credit. Because even the smallest difference in interest rate can be worth tens or even hundreds of thousands of dollars over the lifetime of the financial product. Now that we have a good understanding of credit, the next part of the series will focus on how to actually build this credit. Thank you for taking out time to watch the video. If you actually like the content and found it valuable and would like to see more of it, please hit that like button so the YouTube algorithm can also recommend it to other individuals that might find it helpful. If you have thoughts about the video, please engage me in the community in the comment section. Also, please subscribe and hit that notification bell so you can receive other useful content from this channel. Feel free to add me on Instagram and other platforms. I'll be posting content there daily. Thank you everyone. Till next time, keep putting your future self first.